Hello, everybody. We are back. Jerry's back for episode 6. Sorry we missed last week with the holiday. We got some projects going on over here. Just got a little caught up in those things, so we took a week off, and now we're back. So, Jerry, what's going on?
Oh, well, glad to be back in Tampa. I spent a little time in New York, but it was time to get back here to the sun and the markets. I guess last month was a pretty good month for most people, a few percent here or there. So that's good. It seems like trends are back and doing kind of good. I think it's kind of funny. One of the things that I thought was interesting was Druckenmiller coming out all bearish dollar, and I think our positions from a trend following point of view are sort of bearish and sort of bullish. It just baffles me why people want to look at the dollar or the market when there's so many fun things in each individual currency and stock. You're long some stocks in uptrends, short some in downtrends, long European currencies, short some of the Asian currencies, and it's just, and then yeah, Australia, New Zealand, Canada. It's just kind of fun and it's diversifying, and it's kind of silly to make these major calls. So what does he do? Just buy the dollar index? I don't like that.
Yeah, I don't know what he does, but it makes for good media, good for TV. They can't, the listeners can't, in general, cannot have anything too complicated um, spoken to them. So it's, the producer might be saying, hey, uh, they need one or the other. We got to keep it simple here. We can't talk about all these different markets and some being long, some being short. This is a long only show. Either you're long or you're out. You're bearish or you're bullish, one way or the other. This is all about, concentrated bets and picking and getting it right, making the right calls. And so we need one. We need one call. And I think that's kind of where it stems from. And you talk to people about longs and shorts in different markets, they're just like, "What? I never heard of. Why would you do it like that?" Warren Buffett doesn't do it like that. Why would you do it like that or something? Um,
I think now
uh,
that I trade so many stocks and we're so diversified in the currencies. I mean, you know exactly, and I mean, you must. When I add another currency, you must just like be shaking your head. All these stupid currencies we trade,
it's
but
a wacky list. I gotta say
so
that the
wacky.
the
Yeah,
the Chesapeake Plus Fund is the wackiest portfolio out there.
I'm going to put that in the marketing material, the wacky portfolio.
It's
But
wacky.
and we trade all these different stocks, long and short. We trade a lot of them. It's not like a 10% allocation. So it's a good allocation, a bit more than the other three sectors. So I just feel like I have all my bases covered. And I appreciate to the degree that discretionary macro people or whatever they are doing things differently than me. I'm okay with that. Okay, that's totally fine. I could care less, honestly. But I don't want to miss something to where I don't think trend following should take a back seat to some of these crazy thought processes that we hear these guys talk about. And it'll eventually get on the trend and do well, but you have to be in these markets and you have to have them on your radar. And so I just feel like, for the first time in a long time, forever basically, I'm like ready, like how are they going to outperform classic trend following? I got that dollar thing covered. Because sometimes they're going to walk in and say, "Oh, for these reasons," he throws around charts or whatever, and people love that
Yeah.
stuff. And it's kind of like it's kind of trend or charting, but it's not. You don't have to do it. It's not like a system, so you can just be a free person and use your own brain. And so people kind of like that. Sometimes when they come in and they throw this thing around like short the dollar, they're going to be right. And we're going to be unwinding longs and getting in gear with the trend, slower than the macro guys maybe. But over the long run, we're going to be much better because we're not predicting, we're not coming up with these half baked ideas, and we're way more diversification and rules based. So I just feel like I'm not going to get skunked. You know, like the lost decade. I've got some stocks. Stocks are going to be the only game in town again, one of these days, and we're
Yeah.
going to, we're not going to screw up again.
I hope not. Uh, but yeah, to that point of maybe discipline and on that theme, uh, especially on the theme here in the States of Memorial Day last week. Um, I was we talked about this before we hit the record button, but Band of Brothers, HBO miniseries like 22 years ago, amazing. It was pretty much another iteration of the Spielberg Hanks Saving Private Ryan, basically made into a show, but with a whole different storyline. And this is based on a true story about a paratrooper unit. And so I was watching it this past week, over the weekend, because they were running it all day and all weekend, I think. And the there's 2 points, but one is I think the one guy in the show, Damian Lewis, who's also in Billions, another one of your favorite shows. He portrays the the captain, the mate. I forget what his eventual rank was at the end, but Dick Winters, who he's just just a wow factor leader, and he throughout the show, Damian Lewis did a great job of portraying him, and they run into so many situations where they need someone who's level headed, and in the one of the first scenes after they jumped in Normandy, um, they execute an ambush that night. They land, they're all scattered, they're all gathering together, trying to walk to find their way to, you know, the the point where they gotta get to, and they come across this German uh, German unit who's just moseying along. They don't think anything. Don't think any paratroopers around, because paratroopers were like a new thing then. So um, so they get ambushed in the woods, and the one guy, William Garnier, he's like a hothead, and he just found out before they jumped that his brother died in Italy, so he's all jacked up. So he just wants to kill anybody. And Dick Winters is like, okay, it's picture it's middle of the night, it's pitch black in the middle of the woods in France, and they're waiting in the side of this road to ambush these Germans, and Dick Winters is like, don't shoot until I tell you. No one shoot until I give the order.
Right.
And this guy Garnier couldn't help himself, and he just blasted it. He killed the whole unit with his machine gun.
Yeah.
So good job, but to one point, and then throughout the show, they get into these situations where they need someone who's calm and collected to keep the morale steady and to keep them getting the most out of their skills, which is they're more skilled. They're not special forces, but they're like a new more advanced unit. And they're tasked with like really really high level missions and stuff. Uh, so I guess the 2 points: one, on the Garnier uh, melee of just killing everybody without the command. He one we need to it comes into play later. Like, okay, good job this time, but you can't disobey orders over the long run because you're going to get in real bad trouble. Especially when it's a different situation or things just don't go wrong. Your stupid gun jams, or you don't have as many bullets in the chamber as you thought, or blah 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 blah, whatever. So many things, and then people get killed. Um, so so that's one point. Then the other point is to how important it is, I thought, to have people around you with the same goal, and it could be just like traders talking to other traders, traders talking to other, friends of theirs or whoever about their business or something, and like how, these emotions come up. You want to do wrong things. You want to change. You want to abandon your discipline. You know what the right thing to do is, but man, I gotta make something happen. I got my bills are racking up, or whatever. Whatever these pressures come from, um, how just important it is for a, an adult in the room to keep you calm, to keep things calm, and to be able to vent to them too, and things like that. So that just got me thinking about maybe those 2 points watching that show. Um, which you have to watch, by the way, because you told me off the air that you didn't watch it, and that's a mortal sin as an American, you know, in
Yeah, I
my
love
book.
those. I love shows like that, and for some reason, I'm not. I like not so much the war and the killing, but the
Yeah.
human interaction and heroes, people doing something big. Uh,
Oh, you'll love this show then. It's this
yeah,
is these men are like, whoa, and they're all like men. They're like all 22. So
yeah. You said something interesting. It'll work this time. If when you make mistakes and you don't have a plan and you don't follow the plan, it doesn't always not work. And in following a plan, oh my gracious, sometimes it's just the worst result that you could ever imagine. And with our trend following trading, it's just one of those things where we're very concerned about the here and now, but the only thing that the trend following, well, I don't even know if you say it promises us. I mean, if there's any promise to be had, it's just that if you follow this plan or this process for the rest of your life, you'll probably come out ahead, but not maybe not anytime soon, not the way you like it as well. Oh, the way you like it? Oh, when I was on the podcast recently, I said something that got the guy kind of going, which was I hate 40% winning trades, something like that. I really dislike 40% winning trades, which is not really a comment on whether I'm going to try to increase it. I'm not, but so we can admit to ourselves, the parts of our plan that we don't like. Overall we kind of love it because
yeah,
it's our it's our way to success. That we're that it's okay to tweak it as well. And but yeah, I think he was very uptight that I said I didn't like some things about trading. I think that's what makes our strategy so good is that it's very difficult to really enjoy the ups and downs, the losses, and the profit give backs, even though we're sort of beyond really making errors and not following the rules. But the other part of our brain says, yeah, of course we don't like it, but this is the way life is.
it's the way life is. Uh, you have to just try to accept it as fast as possible because it's not up to us to change. When you do, you're gonna get in real big trouble. Um, because it's just not how markets work. It's not how nature works. You don't get opportunities to, uh, play in the snow every day. You go through seasons where you don't have it, and then other seasons where you get it all at once. And sometimes you get little dribbles of it. You gotta, and same thing with all sorts of weather and all sorts of other patterns in nature that just are clumpy. Just similar to the markets. They come in waves, they come in bursts. There's droughts and things like that where you get lots of periods of inactivity where you just got to sit around and just not lose your mind, and lose your focus, uh, because when it does come around, you got to be ready. You got to be able to act fast. You got to be limber. Keep yourself mobile and be able to jump quickly. But yeah, it's a seems like it's a common thing. It seems common even with, the popularity of 90-day workouts, 90-day diets, and all you got to do is that. And yeah, you don't want this long-term sticking to it, mundane. You got to embrace mundane. That's how I think you get to the winner circle. If you're always looking for this uh, getting pumped and being pumped up all the time and having this new thing to do, and yeah, 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 we're excited. And I see it even with sports teams. It's like, okay, you're not going to win the grand prize, but you're going to have a lot of fun in the meantime because you're getting excited over this little win, this walk-off win. Uh, it doesn't mean anything so much. It's just one little win. Um, don't get confused about what you got to do next though. Like, yeah, yeah, we won that game, but we shouldn't have been in that spot because we didn't play very well. So focus on playing better, and then you might not get that overtime win because you might avoid overtime, but you get a bigger payoff later. I don't know, things like that. Even the best of the best seem to uh, fall into those traps, those mental traps.
You know, I did read an article this morning. You mentioned dieting, and you're in
Hmm.
good shape, and I'm in good shape
Yes,
for my
amazing
age.
shape.
But I did have a big weight loss about 20 some years ago. Just huge weight loss, and I never looked back. But I did read. You should Google this. I did read about this guy who lost 60 pounds just eating McDonald's, and it was the burger, the fries, and the apple pies. It was like because Jared lost a bunch of weight eating Subway turkey sandwiches. So you're like, okay, maybe the bread's not that good for you, but whatever. He was eating sort of healthy with veggies and turkey, uh, but probably had something to do with calories as well. But in this article about McDonald's, this old guy lost 60 pounds. He said basically at the very end, he goes, "Oh, but I only ate half the serving." Well, there you go. That's was sort of the key. Uh, he was eating all this crap, but he was only eating half of it. But that kind of rubbed me the wrong way. Like, dude, you got to come up with something better because you're like wasting half your money. What are you doing? Like, and he was eating breakfast, lunch, and dinner. All right, that has nothing to do with anything. But I did want to ask you another question. You may know more about this than me. You, you you mentioned something else a second ago. I think you said something about boring. I tweeted
Hmm.
this thing this week. It was from a magazine article, and it was about hedge funds losing a lot of money. But then there was this one group that doesn't lose money, and that are these multi-strat firms. I don't know a lot about them other than what I read, which is they basically have all these traders that they hire and they give them very short ropes. They can't lose
Hmm.
very much money at all. I think I have a friend who works at one of these places and he is a trend follower. But like I was asking him, like, you can't hold on to this yen trade like I am, are you? It's like rallied a bunch. He goes, oh God, no, I can't do that. So you have to kind of maybe even if you're trending you have to sort of change your system a bit to fit in because even if you have any kind of drawdown uh, I think they end up firing people. But so the tweet goes like this: if you are if you invest with multi-strats that abide by the risk management they've imposed on all the teams, you can sleep at night. So it becomes boring. But the good thing is they are consistently boring. So
Yeah.
I think my question is, of course, I'm self-centered, is the way we've just described how we trade, with the discipline and the systems and the rules and all the markets available to us, can we approach performance that these multi strats have, especially given the fact that we don't really try to cut profit short by classifying a drawdown on a big profit as some sort of drawdown that we should try to eliminate. So we have much more freedom to hold on to these big trades. I mean, that's a pretty big edge for us because sometimes when you get out of those trades prematurely, they go right back up to the highs again. So you would think that kind of balances off and that we would really do well based upon our more strict rules based approach versus this sort of what I classify as discretionary macro. But you may know more about what goes on inside these firms than I do.
Uh, I don't know a ton. I know that they're ruled by, you can have as many wacky strategies in there as possible. And but as long as they abide by the, within the risk limits that the firm at the higher ups set, then I think it's like no big. I think it yeah, they could probably do well because of that rule. And it's just like us. Like you can do random random entries of any markets, any mix, doesn't matter. And as long as you have proper risk rules, uh, you're going to be fine because again, like if the winners are gonna come out at sooner or later, and then hopefully, I mean, I would imagine that um, the guys at these funds will, however their strategy gets them into a winner, they're going to hold them long enough to do well, to do all right, enough. I don't know how long they hold these things, or whatever. I'm sure some are pretty short, and some might be longer, but yeah, I think those that overarching risk rule handles and is responsible for a lot of the success of these multi-strat firms. But to be an individual trader at one of these, I think is really hard because you lose 5%, you're out.
Right. You
That's
lose
it.
5%, you're out. And that's not reasonable, not from the way we look at the markets. And I don't think you
No.
can be, I don't know, I think it's like you said, you don't even need to be very systematic. You're just a trader.
Yeah.
And you have these opinions and you have this experience. And, and they put all of these guys together in this firm and then they put these strict risk controls on them that are obviously going to have a negative impact on performance. I mean, but a positive impact on staying alive. You would just think that we could compete and we wouldn't be. Yeah, I mean, I absolutely think is how I couldn't think any other way other than saying, like, okay, they have great marketing. They can raise a lot of money because they have this great track record. But look, we're going to do just fine against them. And I'm sure over the past 3 years, we've probably outperformed because the trends have been really good for us. And it's suboptimal and, from our point of view, incredibly incorrect to exit our trades based upon an open trade equity drawdown. And the only way we would do that is we would choose shorter term systems that made less money than the systems we trade now. So that's no good either.
Yeah.
What do you think?
Uh,
I'm trying to take over the world.
it's it, but some people, it's just the feeling is so strong that they don't like, that they just avoid, and they won't embrace it over a long enough period. Not enough people won't do it, and enough people won't do it for long enough to where you'll see any meaningful change. But there will be people who get lucky even by doing stupid things. And enough will get lucky to where people will continue to think that it's a valid way to do it, and they'll keep trying it.
Another thing I listened to this week was Cliff Asness podcast. I love Cliff,
Yeah,
and he's super funny, super smart. Doesn't do trend following the way we do it, but his fun's been great, and he does things way more than just trend following. Right? He does that value stuff. So I
yeah,
just don't think that there's any evidence, though, that we should be jealous that we don't have other things in our portfolio other than all these stocks, currencies, commodities, and interest rate markets. And I definitely don't feel jealous that we should want to do anything other than trend following either. So, okay, so the point I'm making here is they ask him how many employees do you have? And he's like, oh, I have like, I don't know if it was hundreds or thousands. And I was like, holy smoke. Can you
Yeah.
imagine? You
No.
have to have all those people, and there, in my opinion, almost zero evidence that any of that crap can beat trend following. Stocks only. I don't care. Value. I don't care. I probably own some value companies and have no clue that they're value because they, hey, you know what? They were diversifying to my portfolio. I put them in there, and they made an upside breakout. I
Right.
feel very happy that I don't know anything about that world that they live in, and that I feel like they should know my world. But golly, I could never imagine. You know, if I had hundreds of employees and loved trend following and believed in it the way that I believe in it, someone would come up to me and say, "Dude, everything that you're doing with all these people it's not even real. It's only marketing and bullshit." And I'd say, "Yeah,
Yeah.
shh, don't tell anyone."
I may have, I don't know if said this story. I heard this story about John Henry back in the day. And I think, I don't know if I said it on this podcast or when, but one of his clients, someone paid him a visit. They were like, popped in, you know. This was like back, I think back in the 80s or maybe the early 90s, something like that. And, he was, successful at the time, doing well. And all right, so one of his big investors popped in, and he walks in, and there's not a sound, nothing's going on. There's a bunch of guys sitting around with their feet up reading paper, and they were expecting to see like a trading floor, and people doing what they do on trading floors, and I think it's just real confusing. It's like either Hollywood or stupid Wall Street, and you know, seeing footage of the floor, the stock exchange or whatever, the mercantile exchange, just people going crazy, and they think that that's what you need to do. That's how you need to be. And like, no. And maybe I don't know if John Henry would said it at the time, but I'm sure he would agree that yeah, you have to embrace, like I said before, you have to embrace the mundane. We know what the winning formula is, so that's all we have to do. We don't need to talk anymore. Just stop talking. When you have thousands and hundreds of people working for you, it's about something else. It's about, well, we're a wealth management shop. Well, what's that? Well, we try to manage as much wealth as we can. Yeah, so you got to talk to people and get all their money
let's
in the door.
let's manage it.
Yeah,
Yeah. Well,
have to manage it.
it's a little bit similar to the S&P 500. I imagine that whoever keeps track of that calculation each day, it's this big spreadsheet or whatever, or Python,
Hmm.
and he just has his, it's all programmed. And then you go to these firms that manage money in the stock market, and they're like trying to beat this S&P 500. And the S&P 500 guys have their feet up on the table, just watching sports or something, while this
Yeah,
computer runs. And then you can buy that thing and for almost zero, and it's very hard to beat. You got hundreds and thousands of employees, but it's really almost impossible to beat the darn thing. And so you say, well, risk adjusted. We'll beat it risk adjusted. Well, that's not that
yeah,
important in stocks, I don't think. To most
yeah,
people, it's important to me to some degree. I don't want an 8% return and a 50, 60, 70% drawdown. But we do pretty well on that by our own little system with many different types of markets and longs and shorts. And so we don't have that sort of return versus drawdown like the stock market. But I do think it is kind of funny that all of the energy that is spent in managing people's money, it's not in people's best interest to acknowledge that the index is better or classic trend following is better because, what am I going to do for a job? I think maybe AI will take care of all that. Maybe.
maybe. This, still have human beings doing the trading, so um, still got the feelings. That's the real issue, I think, with all this. Um, with producing returns and uh, sticking the system, coming up with a strategy, sticking to it, all these things, and you still got these feelings that come up. Maybe a robot won't, but you likely will because you likely still have a human running the robot. But um, what point was I going to make? Oh yeah, the risk-adjusted returns. Just a fancy way of saying, yeah, we made less money, but we did it in a smoother way. Yeah, great. Well, yeah, uh, it's a weird thing to say, you know. It's like we scored less runs than the other team, but we scored more times in more innings than they did. It's like, shut the fuck up. You know, you sound ridiculous. You know, the other team scored out of 9 innings, they scored runs in only 3 innings, but they scored 10 runs total. You scored 6 runs, but you scored 1 run in 6 innings. So you scored six. You scored in 6 innings versus 3. So your risk adjust is better because it's smoother. No, no, that's all nonsense. Someone made that up at some point. It's like risk adjusted is only good if you're maintaining that level of return, of absolute return. You know, because this game, I can't believe I need to say it about to people. It's like it's about making money. You know, not risk adjusted return, not risk adjusted ratio. So sure, you don't want to get crazy and like do things that are going to blow you up and stuff like that. Yes, but to earn a decent return is goal number one. Bolded, capitalized, exclamation point. You know, all the other stuff is really just for I don't know what, maybe tricking people who are not as well versed in this stuff to think that you're better than you are, so they give you their money. That's like a maybe cynical side of me that believes that, but I don't know. I don't know what else it's for. If
Yeah,
anyone
it's
has any
funny.
answers, let
Just
me know.
we live in two different worlds, and of course, my goal is to for our world to dominate. And I think one of these days it will. One of these days, it's just the history of business that better ideas, crazy ideas, and the innovator's dilemma. One of the that's a great book to read. I don't think there's a
Hmm.
movie, but one of the great things about the innovator's dilemma is that lots of people can come up with good ideas and the same ideas, but it's very difficult for companies that know what the right idea and the new idea is, but they also know that if they implement and start going down that path of this radically new idea, that it will, at least in the short run, really harm their business. And maybe they'd be part of getting rid of their current business. So, since you and I don't have a lot to lose, we're very bullish on our style of trend and letting everyone know that it is really the best, most perfect portfolio out there. And yeah, that's my that's what I'm going to spend a lot of time over the next few months making sure people know that as my new ETF comes out, which I can't talk about.
Yeah.
So don't you
I mean,
can ask me any question you want. I'm not going to answer.
okay. Uh, oh yeah, I think we definitely have the benefit of being able to adapt our, you know, it's really, if you think of it like a fractal, like the the in the inside, we can adapt our business very easily. You know, we're not like okay, use like Blockbuster and the missed Netflix opportunity. So I think Blockbuster had the um, opportunity to buy Netflix for like 50 million bucks or something like that back in the day, 20, 30 years ago. And they passed on it because the CEO of Blockbuster thought it was, Netflix is nothing. It's not going to last. Get people want to go to the store and look at and select their movies and things to watch. They don't want to get it in the mail. They don't want to just get it online. You know, and that was dead wrong. So maybe he felt, or it would be, practicality, the practicality of adapting his whole business to, okay, maybe if I don't buy Netflix, I try this myself. Oh, what are we gonna do with all these stores? We're gonna do all this inventory. We got to sell it all. Like, what are we gonna? Who's gonna buy it? And then we're gonna tell people that we're gonna change to Netflix, and like it makes us look like they beat us, and like all these things can come up. And then we're gonna not gonna need all these people working. Uh, then we're gonna have to fire people. That's not gonna look good. Wall Street's not gonna like that, or like all these things that that can come up and really consume. It's like, you know what? Let's just tell ourselves that it's going to be fine. Let's just tell ourselves that Netflix sucks. And okay, yeah, that's much easier. And we get to feel better too. Oh, great, great strategy. But you, you can lose big because you're all in on that position. We are not. We don't, you know, we could ditch things in a heartbeat. It's very easy for us. I can go in right now on this podcast and just sell out of something if I wanted to.
Oh yeah,
I don't need to.
that's absolutely what Druckenmiller said about that dollar short that he was talking about. He says, "Yeah, but don't the next time you talk to me, I could tell you that I got out of that trade or I changed my mind on that, the next day or two or week." So I think that's why people kind of like him because he sounds just enough like a trend follower, flexible and
Yeah,
paying attention to prices and stuff. Yeah, so that's exactly right. We don't have any loyalty to anything, and people complain about maximum indexing, and indexers are just hurting Wall Street capability to do research and understand what these companies really are. And if everyone's going to be indexing, it's not the fundamentals are not willing out, and I think to some degree we're the same way. We're just looking at these trends and paying attention to what the market is doing without any sort of idea of do your own research and come up with
yeah.
your own ideas rather than just following the market. But oh well, it works best and it's the safest. So what are we to do? And we are thankfully, as you said earlier, we're humans, and humans will never get out of this idea of trying to predict. And yeah, when you were talking about AI, I wanted to say like, this AI is going to have the personality of these people, which is risk adjusted. We have to have returns, minimize the volatility because this is what matters, and it's going to be. And so it'll be a long time before some smart person says, "Hey, forget about this volatility and this Sharpe ratio. Let's have an AI that just tries to preserve capital and lets profits run." That's when you and I'll be in big trouble.
Mm. I'm sticking with what we're doing.
Yeah.
But yeah, I think I don't know. I think that's about all the thoughts I have today. Uh,
Yeah. Yeah. I think we've gone over our half hour.
yeah,
Yeah.
yeah, 37 minutes. I think I'll
Okay.
call it. That's good.
Yeah.
38 minutes.
Sounds good.
Okay, well, that wraps up episode 6. We will be back either next Thursday or Friday, um, depending on Jerry's very busy schedule
The
of
problem with the
travel.
problem with Thursdays, it's on the calendar for every Friday at 10 o'clock. So
Yeah.
the problem with Thursdays, honestly, I don't know if I've told you this. My house gets cleaned on Thursday, and they start running the vacuum cleaner.
Ah, okay.
You see, there you have it.
Yeah, it's a bit much, right? We don't
Yeah.
want that.
No. Oh gosh. Okay. Yeah.
Okay.
But yeah,
All right, so Fridays.
next Friday.
We'll stick with Fridays, and we'll be back next Friday, June 9th.
Happy birthday,
Um,
Preston.
Happy birthday to my son, 4 days, next Tuesday.
Yep.
Um, maybe he'll He'll greet us on one of these podcasts one day.
It's only
But he
fair.
yells. He's in a big yelling phase right now. So he's
It's only
almost won.
yeah, yeah.
So
It's only fair. I can bring up.
yelling dada, yelling. He's into B words right now. Yelling
Hmm.
everything with a B word.
Okay.
Banana, bottle, bibs,
Okay.
ball, all of it. Berries. He loves berries.
Oh wow.
He just yells you know yells berries. He has a bear. He yells bear. So he's all bees right now. So maybe next week I'll um, get him on here. But
All right. It's been fun. Have a good
everyone
weekend.
have a nice weekend. Nice weekend, and talk to you next week.
Yep. Next
Bye.
week. Bye.